On this episode of Risk Matters, What Matters, my colleagues Claes, Norgren and Damian Robinson will join me for a discussion on three important trends. The first has to do with the emerging technologies that are now entering the financial services industry. The second has to do with regulatory developments, and we will go through the key issues of that matter. And then the third has to do with geopolitics and macroprudential issues which of course are very, very important given all the developments that are taking place around the world today. If you like the content, please subscribe to the channel and give us a thumbs up. Gentlemen, welcome. Claes, let me start with you on the European regulatory agenda. If you can just provide a quick overview of what that looks like given the latest developments. And what should compliance departments within banks be thinking about?
Here, Arion. I think that looking at the regulatory agenda and the implications for compliance these days, in this point of time, needs to also not only take into account the changes in regulations, directives, what has been newly executed and what is in the pipeline. I think the challenges that is on the market are so fundamental that it has to be a broader perspective where you take into account the impact on technology, but also on the macroprudential and geopolitical developments, because they interact with compliance a great deal, and I think that has to be factored in. So this is the way I would see it. But let's start with regulatory developments. Clearly, we have seen that the competitiveness issues are high on the agenda. We have been reviewing the Draghi report. I think it has had fundamental implications for policymakers, and we have a work on what is called the Omnibus Directive. I think that from a compliance and market perspective, this is very much welcome, but I would need to say that we have heard this before. We have heard the intentions to streamline regulations to make it more lean and efficient. And I think that's really something important. But the implications for compliance, to see the results of that in real life, I think that will take a considerable amount of time. Then, of course, linked to this, we have the impact of the new US administration, which is giving the same kind of direction for policy to try to deregulate. We have seen one example in the area of capital requirements where leverage ratio has been abolished for US banks. And we also need to consider the direction on ESG. I think, however, that if you look at the compliance issues, we can still count on that in Europe, the regulatory requirements on climate-related mitigation will be around, and I think that is important to follow. Underneath this, in terms of the regulatory developments and how they will roll out, of course, there's the question about global or regional solutions, and we have to find out about that. But more practically speaking, for banks now, I think they are at a turning point when it comes to implementing new regulations. We have the AMLA and in the AML space, the implementation of a new supervisory regime, and we do have a number of technology-related regulations such as DORA, AI Act, EDAS, etc., that will be rolled out. The question is how much of this that actually will lead to a number of new regulations, or if there will be a scale down. I think that we can safely bank on that the requirements for compliance departments to still work on the implementation will be heavy, and that there is the risk of compliance fines if you don't. So these are some perspective on the regulatory requirements.
So the compliance departments, which for years had more and more regulations to deal with, probably shouldn't take much comfort in thinking that somehow the regulatory burden will be lightened. It sounds like it's probably shifted and the composition may have changed slightly, but in aggregate, the amount of work probably remains the same.
Yeah, no, I mean, I think that's a pretty fair statement. Not only can do not only can they not expect the regulatory burden to be lightened, but in practical terms, in terms of sort of executing against the regulatory requirements, I think the situation is going to become more complex going forward, for a number of reasons that also touch on some of the topics that we're going to be talking about in a moment. The technology and the sort of macroprudential risks. But a couple of things that are on my mind in that regard are, we talked about, Klaus mentioned the emphasis on competitiveness in the regulatory sort of agenda. And I think another thing to look at is the growing sort of awareness within Europe that the continent has to be able to start spending more on its own defense, and that certainly has implications for the kinds of business that banks are going to be increasingly called to do. I mean, and a lot of banks, don't get involved in transactions that involve military material, whether it's weaponry or other kinds of military supplies. And, so this new kind of thinking on the agenda calls that into question, and how much involvement is there going to be? How many new companies are going to spring up that are involved in military production, and what are the compliance implications there? And so that's one thing. And another thing is on the competitiveness agenda, when populations in Europe are aging, we know a big part of the competitiveness debate centers around immigration and younger workers coming in from different areas, and that's certainly a hot button for a lot of people in Europe politically. But when you talk about immigration from countries where there are traditionally, compliance concerns, what does that mean in terms of, worker remittances to their home countries, and being able to screen those things, and so I think the picture becomes a little more complicated there. And then finally, I'll just mention, on the technology side, I mean, Klaus mentioned a couple of things like, the AI Act and AMLA and all those things. And obviously, those are things that are high on the agenda of banks trying to understand what's coming down the pike and what the implications are for them. Another one of those is MiCA, the markets in crypto assets. Crypto assets are an area where traditional banks have not necessarily sort of gotten their heads around, and certainly don't have good ways to understand what their clients are doing in the crypto space, and the implications that may have for anti-money laundering, and being able to understand, source of wealth and things like that. So that's another area that needs a lot of focus.
Could I just add to that, Damian? I think that to the equation also in the area of how compliance need to take the regulatory developments into account is a kind of continuation. To me, that is clear, and that is how the European institutions work, that you get the regulations rather than the directives. You have institutions like EBA, ESMA, etc., who fills that out with regulatory technical standards that kind of provides a common framework that has become much more manifest. And I think that development will color the developments the year ahead.
So I think that's a good segue. We've talked about the different types of regulations. We've talked about what's happening in the US and how that could impact the regulatory agenda in Europe. And again, we sort of repeat the somewhat bad news for banks that the overall regulatory burden in aggregate will not go down, may even go up perhaps. But it probably poses some challenges for banks, given that they'd become quite good at AFC, anti-money laundering, and so forth, whereas now they have to add several other capabilities in areas such as crypto, for example, which again will probably make their lives a little bit more complicated. Claes, just a last question for you before we move on to the technology side. You've served on the Basel Committee for several years, which is the international body that makes a lot of the regulations that the local countries have to follow. How much do you think the potential changes in the US will affect the regulatory landscape in Europe, given that you've seen how US and European regulators interact with each other from your time at the Basel Committee?
Well, I would think that I mean it's the G20 countries that will kind of determine how this plays out, and it depends on how much the US will be the odd man out. I would still think that in the G20 and the Basel Committee, as an example, corporation, they would still continue their agenda. The problem might be that the US will not implement what is agreed on. And I think from a European perspective, I think the European regulatory policy coordination is sufficiently robust to kind of continue. Of course, there will be considerations to avoid a too kind of diverging competitiveness situation, but I think that that's how it will look like.
Thanks for that. Obviously, you have a unique advantage, and so it's important that our viewers understand how the interaction and the relationships between different countries evolve when it comes to ultimately the local standards being implemented. Let's move on now to the next point, which has to do with technology, which is always a hot area. In one of the podcasts, the interviews we did live in Washington with Gene Ludwig, who of course is a very well-known ex-regulator and consultant and investor, he had said that as long as you put the word AI into any startup, that you could probably get funding fairly easily. But what we've heard from our clients and the various banks and other organizations that we speak with is that 2024 was really a planning year when it comes to AI, whereas 2025 is probably much more of a implementation year, perhaps not full implementation, but at least starting to think about how it is that they'll go about putting into effect a lot of the ideas and strategies around AI. How should banks go about thinking further about AI, given that they've already thought about the basics, and what should they be doing in that direction?
If I just take this from my vantage point of view, I think this is something that has gained such a momentum. So I think everybody are running with it, and I think Gene is right. But it's not only because you say it, it's also because everybody does it. And why do they do it? And of course, there are tremendous efficiency gains, and especially also in compliance. And what does this mean for compliance then? First of all, I think that in the area of controls and control management, AI and technology offers tremendous possibilities to automate controls. And I think that that is an area where a lot of work will be carried out. So given what I think are the potential gains here, I would certainly think that this should be top of the agenda. At the same time, one has to be wary of the risk of crooks. The enemy is outside, so to say. How do they use AI? Do they do it? And what are the implications? We have seen kind of mass scale fraud related to payments and other areas. And I think that compliance really need to take this into account, balancing that development. But there is also the question about how supervisors can benefit from technology. In the area of supervisory technology, I think that there are new potentials for reporting to make that more efficient. We see in Europe, EBA setting up the Euclid reporting, a centralized reporting, but also more generally in the supervisory work. I think AI can and will be something that is more used. So these are some of the points I would like to flag.
Yeah, if I could just
Go
add
ahead
to
there. Yeah, yeah.
I mean, I think Klaus is absolutely right. There's just tremendous benefits to be gained in terms of efficiency and both cost efficiency and effectiveness of controls by using artificial intelligence. And banks have been doing that for a long time already in different ways. Now the technology has developed even further to allow things that were not possible even just a couple of years ago. And I expect that we're going to see, and we're already seeing banks experimenting with those technologies, and it's going to take a while for them to work out the kinks and sort of understand how to apply the technology in the right way and with the right governance and the right guardrails and so forth. And obviously, those are areas that we can help with. But going to the other side that Klaus also mentioned, the dark side, criminal organizations are also going through the same exercise. And in some ways, they are probably, a step ahead in the sense that, they're usually early adopters of things that can help them perpetrate their nefarious activities. And they don't necessarily have to worry about, regulators and, guardrails and so forth. It's amazing the way the technology is developing so quickly, and in fact, it's a little bit scary. I mean, if I'm sure some of our viewers have seen Google's VO3 technology, where it's possible to create AI characters and dialogues and that are very, very, very difficult to distinguish from real life. And and I'm sure it won't be very long before it will be virtually impossible for a human to distinguish between an AI generated character and background and dialogue and interactive dialogue and so forth from real life, and where it's going to be increasingly necessary to have the capability for AI to essentially detect other AI in verifying identities and verifying transactional behavior and having conversations with customers. I mean, a lot of banks that we deal with, when they're doing their customer onboarding or their KYC updates or whatever, have video calls with clients and ask them to, hold up a copy of their ID or their passport or whatever. And, there are certain tests that can be done to detect whether or not those are real images. But, with the level of technology that's developing now, humans are not going to be able to keep up with that. So that's a big sort of red flag that financial institutions have to watch out for, and regulators likewise also have to take that into consideration in how they approach this whole development.
Could I just add here, Damian? I agree. This is in the new world of digital banking. I think that we are in a new territory. You have the very basic question when you're doing business and interacting with customer, other banks, or whoever. The question that you have to pose yourself: who is there? Do I know who that person is? And
Yeah.
given the kind of complexity and the threats you just mentioned, I think imperative that the work on developing trust services to make the digital space a trusted place to be in. There, I think a lot of more work needs to be done. And of course, the EIDAS work in the European Union is one factor, but there needs to be a lot of investment in developing this.
Yeah. And I think, going back to the discussion about compliance functions and how difficult things are going to become, um, it's hard enough for banks to do what we were just talking about, to make sure that they understand who they're truly dealing with, and increasingly to be able to detect whether something is real or AI or whatever. And banks are generally pretty well funded and have a high level of technology, and are very motivated, whether it's by their regulators or by and supervisors, or by their own boards, to get these things right. But then when you think about the bank's customers, businesses that are dealing with other businesses, and don't have the same level of resources that they can bring to bear on these things, it really calls into question this whole concept of know your customers, or sort of the extended network of people that you're dealing with by virtue of the fact that you have a customer. And that, I think, is just going to become a much more complex equation to have to solve, because as I said, the customers themselves are not going to necessarily have the same level of resources or wherewithal or awareness or sort of motivation and requirements to do these things, whereas the banks do. And so how do you deal with that extended ecosystem? Again, this is maybe jumping ahead a little bit to the macroprudential risks part of our discussion, but when we think about the tariff situation going on in the world, and the potential that trade routes and trade relationships will be disrupted because of that, and people, banks' customers may start dealing with new trading partners, new geographic areas, and so forth. That's a lot of uncertainty and a lot of new sort of parties on the line that have to be verified and understood who they are and what their source of wealth is, and so forth. So it's a complex problem to have to deal with, and especially when you start bringing AI into it, in terms of what could be done to circumvent regulations.
What I would say to close this segment, and of course it's a huge conflict of interest for us because we offer these types of services, but banks should start thinking much more about fraud issues, given that the capabilities of the bad guys are actually quite developed. And of course, the European regulations have changed now, and so the cost of any fraud events are not solely on the customer, but in fact the banks will also be on the hook for some of that. And so of course there's sort of a large reputational risk that comes into play at this point. But we think that banks really need to have this so-called single view of fraud. So the fraud management in most organizations is quite fragmented. And so it makes it quite difficult for banks to have this common view. But boards will really need to understand that. And so I will say that in terms of a very important agenda topic in closing. Let's go now to the third topic, which relates to geopolitics and what we call macroprudential issues. Obviously, we've done podcasts on various issues such as tariffs, interest rates, sanctions, and other areas. And of course, those are all available on our YouTube page for our viewers to review. But back to Claes on this. As we see all these different things going on, and in the US, there's the so-called big beautiful bill that's making its way through the House of Representatives, which of course adds more debt to the huge debt that the US already has. The tariffs discussion is now on hold, I guess, until July, even though there's a lot of back and forth. The sanctions regime, at least when it comes to Russia, has not changed. How do you see all of these different things impacting banks and other financial services institutions in Europe?
Well, I would argue that although that macroeconomic and geopolitical issues have been long on the agenda, I think that something fundamental is going on that calls for special attention. And I think a help to kind of structure this is to look at the concept of macroprudential regulation. That is something, a vocabulary that is good to have and to see how it can be applied to compliance matters. Now, the issue is that in terms of safety and soundness in banks, there are macroeconomic and macro-political developments that seem to be outside the kind of pure regulatory agenda. But sometimes they're not. Sometimes they are interacting. And sometimes when you work with regulations and compliance, you really have to be aware to look at redundancy, to look at diversification, to look at different scenarios. And of course, the current geopolitical developments with a tariff war, where we wake up every morning with new news and non-news and whatever that is. I mean, that creates a tremendous amount of uncertainty, not only for the dollar, the euro, the interest rate, the prices, but also for the political development. And there, I think, in terms of compliance, one has to put into the equation the localization of infrastructure. Political events might not be benign. We have seen wars, we have seen conflicts, and there are real risks that one has to take into account of when you decide upon the localization of different activities. And that includes also compliance and how that work. And if you have to kind of reallocate your banking business for safety reasons, you have to put this into the equation. How does the judicial choices impact on compliance? Are you ready to take into account changes in sanctions regime very quickly? How can that be done? What kind of readiness should firms have? And I think that, of course, what we see today is that there needs to be more readiness, there needs to be more redundancy, and there needs to be a scenario analysis to also inform compliance.
Just to think about, again, bringing this back to sort of the customer level of, we're dealing with financial institutions largely, and they're all dealing with, thousands and, tens of thousands of customers. And, just as you said, Klaus, about redundancy and diversification in order to protect the bank and its operations from macroprudential risks. I think we may find that, or financial institutions may find that their corporate customers are also making those same kinds of calculations and diversifying their holdings, diversifying their banking activities. And that also introduces a little bit of additional risk into the compliance realm, because when you're a bank and you've got a corporate customer that does most of their transactions through you, you have sort of a broad view of their activity and you understand what's going on. When suddenly they start to bank with two or three other institutions in different places, and here we're talking about in the European Union, where it's not very difficult for a company to have a bank account in multiple countries. And they may do that for different reasons, but if they're increasingly doing it for the reasons of diversifying and spreading their risk, the bank that used to see most of their transactions may now only be seeing a part of it and may not have a good picture of what they're doing. And that starts to lead to more questions on the compliance side. How can I really understand my customer and what their activity is and what's normal and what looks right and what doesn't if I only see a small part of the picture? I think from that point of view, it's also important for institutions to start being able to talk to each other more and to be able to share more. And of course, that has regulatory implications, privacy, data privacy, and other things. But that's an area that I know, Klaus, you've done a lot of work around public-private partnerships and so forth. And maybe that's another area that needs to be revisited in the light of the macroprudential shifts that are taking place.
Sure.
So in closing, what I would say is that it appears that there's a lot going on. Banks almost need to hire an oracle like the ancient Greeks had in Delphi to sort of tell them what's going on. But short of having an oracle, what they can have is horizon scanning, which is a very important capability that a lot of the international banks have, which is really looking at what's coming across the horizon when it comes to regulations and trying to anticipate those changes. And of course, adjusting their programs in order to meet the future agenda that's coming down the road. And just like one of our original podcasts was about the role of the risk function and how that has shifted from only being focused on credit and being focused, or I should say primarily focused on credit and now being focused on many other issues such as technology. In the same vein, compliance departments will also have to focus on a more complex regulatory agenda with everything that's going on. And so all I can say is that it's going to be interesting times ahead for compliance functions, and I hope that our viewers will stay tuned to this channel for further materials. So with that, let me thank Claes Norgren in Stockholm and Damian Robinson in Athens, and ask you, the viewers, to stay tuned for our next episode. If you like this content, please share this video and give us a thumbs up and subscribe to the channel.